This is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. It's Monday afternoon, the 20th of April, and just wanted to come back to you with some updated opinions, thoughts, observations. Obviously, we're monitoring the situation very closely, both in terms of the investment backdrop as well as the economic backdrop. There's a lot of data that we're following from people like First Trust and Bob Stein, Brian Westbury, listening to a lot of conversations that are taking place at the Federal Reserve Bank of Dallas and other Federal Reserve banks around the country, and then paying attention to some data that is being compiled by my good friend Sandy Leeds over at the University of Texas. And just wanted to provide you all an update of what we're seeing. Some of the data, again, we're on the cusp of receiving a lot of bad data related to the shutdown and the coronavirus impact on small businesses. And so there's a lot of negative data. The silver lining is that we do see the opportunity for green shoots, which would be kind of the advent of more positive data as we get into June and particularly into July and August. And so we've got some commentary on that. But, suffice it to say, the news over the next really the 3 months of releases are going to be bad. And we feel like we're already in this recession that we've kind of alluded to in the past. But, the data would tend to support the fact that maybe the first 3 months of the year ending March, at the end of last month, was negative because of the impact of March, the negativity of the impact in the last half of the month from coronavirus related shutdowns caused the first quarter to be negative. Now we know the second quarter economic growth, if you will, or I guess negative growth, if you will, is going to be negative 20 to 30%. We just don't know where. The data will kind of flesh itself out over time, but I guess the early reads on the data that we can see now would tend to suggest that the economy is going to be down about 20 to 30% in kind of a shock fashion, because this is very unprecedented that there would be a manufactured shutdown of such a large swath of the economy. Now, unemployment rate, we feel like it's probably going to be somewhere between 10 and 20%, and we've enjoyed, basically low to mid 3% unemployment ranges for quite some time, and so that's obviously spiked up. I mean, we've had a tremendous increase in the amount of unemployment applications and continuing claims, which we'll get into in a second. But those things are clearly showing a spike, giving us the impression that the unemployment for at least a short period of time is going to be relatively high. But I wanted to first give you some data, at least on the last week, and I can tell you that the volatility in the market continues even beginning this week as the markets are down. We've seen oil prices actually go into negative territory, just meaning that there's much more supply than there is demand. And so literally people on these near-term oil contracts are paying you to take the oil, which is entirely unprecedented. Just shows you the degree to which the coronavirus has dislocated very specific markets. But if you look at, at least last week, for the week, the Dow Jones was up about 2.25%. S&P was up about 3%. Year to date, Dow Jones is down about 14.5%. The S&P is down 10.5%. And if you go back to 2019, the Dow Jones was up 25%, over 25, and the S&P was up 31%. So if you go back and you say, all right, from the beginning of beginning of 2018, all the way through essentially the I guess, call it the 17th, 18th of this month. I mean, the market, the Dow Jones is still up about 10.8% from that point to point. The S&P is up almost 21%. And just to give you all some perspective, again, kind of this, amidst all this bad data, at least some hope or something that we could look forward to. I mean, the 5-year annualized return in the Dow Jones average is up 8.96% through the end of last week. And that number is 8.87 for the S&P 500. So that's almost 9%. And if you go back all the way to 1926, if you reinvest dividends, the average annual return in the S&P 500 is over 10%. So this is not too far off that. So again, kind of giving an eye, recognizing the data as poor as it is now and its impact on the volatility and the investment markets. I mean, if you look over a long-term perspective, it's clear that there's an upward bias on an annual basis in these markets. So again, living in an unprecedented time with just a cataclysm of a lot of different things going on. But the long-term perspective, I think, is still very much intact. One observation I'd like to make on the S&P 500 is that, from the low on March 23rd, the S&P through the end of last week was up 28%. However, that was not evenly distributed. And the real interesting thing about this is if you look at year to date, I told you the S&P was down about 10.5%. Small caps, the smallest capitalization companies that are publicly traded, as defined by the Russell 2000, are actually down 26%. And what's interesting in this is small caps have really been hurt. These smaller companies tend to have less robust financial statements, less robust balance sheets. They don't have this kind of robustness in their internal operations, their financial systems, their capital access, as do the larger companies that we read about every day. And so they tend to perform, I call it less well during this period. But since the index peak on February 19th, the 100 largest stocks have dropped 16%. And then the smallest 100 stocks have actually dropped 35%. But we see some data that tends to suggest that actually certain sectors are doing well in this environment. So despite the fact that we know that auto sales, and just looking at retail sales now, auto sales in general are down about 25, 26%. Restaurant bar sales are down 26%. Clothing and accessory store sales are down 50%. Gasoline sales are down 50%. In fact, from the beginning of February, miles driven is down almost 50%. But on the flip side, food and beverage sales are up 25%. Internet and mail order sales are up 3%. And warehouse club sales, like a Costco, Sam's, are up 6%. So what's interesting is that, we've got some areas that are actually performing well, where essential items that people are purchasing, some areas are not. Rail shipments are down 6% year over year. Steel is down almost 20%. Hotel occupancy, again, the leisure entertainment sector is about 10% of the economy. And we know that hotel occupancy is down almost 70%. And so that's a very, very compelling statistic. Unemployment-wise, we know last week 5.2 million people filed for unemployment insurance. The 4-week total is 22 million. And actually, if you look at some data that I was reading not too long ago, since the Great Recession, we've actually added almost 25 million jobs. And this is the Great Recession of 2008, 2009. And in the last 4 weeks, 22 million people have actually filed for unemployment insurance. And so just a quick note on labor before we move on to some other things. During the last two recessions, or exiting the last two recessions, it took somewhere between 48 months or 4 years and 76 months to recover the jobs that were lost during those recessions. So keep that in mind as we look at kind of this destructive force and what it's done to unemployment. It's going to take us a while to get back to where we were, and we'll talk about that in a minute. Some of the things that we're looking at the work of Bob Stein at First Trust, and some of the things that they're looking at and monitoring, obviously, unemployment claims. And they think that it's already peaked. So the magnitude of the weekly unemployment claim number has already hit its peak, and we'll see higher claims than trend line, but it's not going to be as high as we saw a couple of weeks ago. Continuing claims, which is kind of more that moving average, they don't think that that's going to peak until July. So again, this would be kind of the moving average of people that once they've filed for unemployment insurance, that these are the continuing claims that follow on from that, that will eventually see a peak in the midsummer. And the other thing which I thought was interesting is they're looking at federal tax receipts. And so they look at what they call high frequency data, and that's data that comes out every week, certainly every month, so we can get an early read on the economic picture from this weekly federal tax receipt number. And from the beginning of April, on a trailing 20-day basis, the receipts were down 5%. You got into that next week, which is April 14th, they were down 10%. And then they're going to be down probably more than that in this next week reading. But they think that there's probably a turning point in those tax receipts. Again, kind of June, July, midsummer, really the end of that second quarter. And just looking at everything in total, they really don't see well, let me rephrase that it looks like it's going to take about 18 months collectively to get through the issues that have been fostered here in this downturn. It's going to take a while to recover lost jobs. It's going to take a while, as we've talked about, to restart manufacturing and rebuild supply chains. In a lot of cases, some of these 22 million displaced workers will be rehired, some won't. People have to go out. There will be probably a competition for certain skilled labor that might actually drive wages a little bit higher. But either way, there's a dislocation in a lot of areas of the economy that's going to have to be worked out. And even if we have this negative economic growth in the second quarter, and in the second half, I think by all estimates, we're going to have positive growth as we kind of trough out and begin to U-shape gradual recovery, that you're not going to have enough growth in the second half to offset a negative year of 2020. And it's going to take basically the next 6 quarters to get us back to where we were in terms of our total economy down the road. So, and then as far as inflation goes, I think prices are actually, with the exception of certain areas of the economy, are actually in a deflationary spiral. Obviously, commodities have gone down with regard to energy prices, but for 2020, we don't see a lot of inflation. 2021 could be higher inflation, not necessarily labor related, but right now we've got a lot of stimulus money that's finding its way to pocketbooks. And anytime you have a situation where you've got more money chasing fewer goods, and we know that production has dropped because of shutdowns and whatnot, so more money chasing fewer goods, that sets the stage for potential inflation. So while we don't see it clearly in 2020, inflation may rear its head in 2021. So we definitely want to be cognizant of that and watch that. And the other, another issue that I wanted to mention here is with regard to our federal budget deficit and what the Fed's doing, Federal Reserve is doing, entering the downturn or entering COVID-19, we had a $1 trillion budget deficit. And the Congressional Budget Office, with the stimulus packages that have been enacted, and remember, we've got one that is now actually being debated in Congress, a 4th generation package, which will help more small businesses and help municipalities, could lead us by the end of this year that deficit could go from $1 to $3.5 trillion, which would be 16% of our economy. So, and we haven't seen that level since World War II. So again, more on the unprecedented time. The interesting thing on that, though, is that the interest rate that the government pays, and just think about our annual federal budget, and there's a disproportionate amount of money that gets paid on interest on our federal debt. And prior to COVID-19, that was 2.5% or 2.4%. That's the average interest rate paid on treasuries. The new issuance related to going from that 1 trillion to 3.5 trillion, that interest rate paid on that new debt is going to be around half of 1%. So the interest rate burden, if you will, is going to be tempered by the low interest rate. And what that's going to do is put a lot of pressure on the Federal Reserve to keep interest rates low, because there's a conundrum of that the Fed has, and do we support higher rates for savers versus keeping rates low to keep the federal budget deficit and the burden and the strain on our federal budget as low as possible. And it's a conundrum, but I think in the end it's going to err towards the side of the pressure being to keep rates low. And so with that, the Federal Reserve is, this is something we talked about last time, that there's this theory that is evolving here that we can solve these problems just by creating money. And again, that may run the risk of inflation down the road, but at least there seems to be a general consensus that, that we need, that the Federal Reserve can create as much money as it needs to help address this problem. So they're buying a lot of investment grade bonds. They're buying a lot of junk bonds. There are caps on that, but they are buying junk bonds. They're buying exchange traded funds of junk bonds, and they're buying a certain amount of corporate debt, and they may even get involved in helping to buy municipal debt. And this would be, again, these are some areas that the Fed has never tread into before. So very interesting times. So one thing that I wanted to point out with regard to municipal budgets, we're beginning to see the strain on municipal budgets related to unemployment claims and some of the response measures where the costs are being borne by municipalities in the states. And we're beginning to hear more stress at that level, where there's going to need to be some federal response, a fiscal response to help some of those struggling cities, counties, and states. And just from a public pension standpoint, at the end of the first quarter, the 100 largest public pensions were only 66% funded versus 75% at the end of last year. So we're not only seeing budgetary stress, but we're also seeing, from a pension standpoint, a stress. And with the market being down, we can certainly anticipate some stress on corporate pensions as well. So suffice it to say that that we've had a lot of early data, and that has not been conducive. We're going to get a lot more bad data. The market expects that. The market has priced this in. We'll have to wait and see what happens in the energy markets, because they're extremely fluid now. We've never seen negative prices for near-term contracts for crude oil, and it's very unprecedented. So we'll have to continue to monitor that. We got, just from a global standpoint, the International Monetary Fund came out with their World Economic Outlook last week, and they're predicting that through 2021, the global economy will lose about $9 trillion of output. So far that the fiscal response here in the U.S. has been about 7% of our own GDP. Eurozone is roughly about 4%, but that there's going to be more response. That's going to take some time to kind of filter into the economy. So they're looking for a substantial drop of roughly 3% overall in the global economy, but with some growth next year. So there's a lot more data here that maybe I'll save for another call. We hope to continue to do these on a weekly basis and just providing you some updates and some current thinking. I'd say, we're continuing to stay the course, trying to optimize portfolios, if you will, being sensible about where we're putting money. I think higher quality overall is very sound strategy at this point. Maybe a little extra cash is sound strategy at this point. Being sensitive to credit quality on fixed income is a sensible strategy at this point. So we welcome your questions. We welcome your input. We welcome your feedback. And you can find us on the web at www.bkawealth.com. And please feel free to reach out to us. We're here to help you. And we hope you have a wonderful week. Thank you.